Hey everyone, welcome back to the channel. My name is CJ and I'm an investor and software engineer based in Chicago. And today I want to talk about Mohnish Pabrai's recent discussion and Q&A session with the Manual of Ideas, Best Ideas of 2021 series. I'll start with a brief background about Mohnish Pabrai and then jump straight into the three key takeaways from his discussion, which covers some of his investing insights that he learned in 2020 that he will continue to use going forward in 2021. Before we begin, please like and subscribe to the channel if you find this video useful and want to see more content like this in the future. I'll have timestamps in the description below if you want to skip around to any part of this video. Okay, let's see what kind of insights we can glean from a great investor like Mohnish Pabrai. Okay, let's start with a quick background about Mohnish Pabrai. Pabrai is a value investor based in Irvine, California, and he's been running his fund, Pabrai Investment Funds, since 1999. He has handily beaten the S&P 500 throughout his career. He is a true believer in the teachings of Warren Buffett and Charlie Munger, and I've actually been to a couple of his annual meetings that he's held here in Chicago. And besides Warren Buffett and Charlie Munger, I've probably learned the most about investing from Mohnish Pabrai, so he's definitely an investing hero of mine. We can cover Mohnish's history in more depth in another video, but for now, let's move on to my three key takeaways from his recent discussion. The first lesson we can take away from Pabrai is simple but not easy. Buy great businesses and hold on to them for a long time. Pabrai attributes all of his learning in 2020 to the fact that he had so much time on his hands to navel gaze, as he would say. He wasn't able to travel the world visiting businesses in various countries, so really all he could do was stay at home and read and think a lot. During this time, he read Nick Sleep's entire series of investor letters. Nick Sleep is an investor who ran a fund from 2001 to 2013. He's somewhat famous in the value investing community for closing his fund in a pretty unconventional manner. He was running around $3 billion at the time in his fund, so it's pretty unusual for someone just to close up shop like that. Anyway, he wrote a letter to his partners at the end of 2013 explaining that the majority of the portfolio was made up of three stocks, which were Amazon, Costco, and Berkshire Hathaway. He said that in 10 years from now, in all likelihood, the majority of the portfolio would still be in these three stocks. So let me return your money to you, and you can stop paying me ridiculous fees, and you can just go buy these three stocks on your own. So you can imagine what kind of returns Nick Sleep would have had he kept his fund open from 2013 when he closed it until today. Even if he didn't achieve the absolute best returns he could have within that time frame, he definitely was able to sleep well at night because of the quality of the businesses within his portfolio. Pabrai then went on to describe his portfolio as an aircraft carrier. It takes a long time to turn, but eventually he will be focused completely on long-term compounders. He actually started his career looking at long-term compounders, but he quickly switched to a more quantitative Benjamin Graham style type of value investing. He started looking for dollar bills that were selling for 50 cents because the valuations during the dot-com era when he started his fund were egregious. There are a couple downsides to this deep value Grahamian style approach. One is that there are constant transaction costs. Taxes are eating away into your ability to compound because you have to continually buy and sell these companies. Another is that there's a massive mental energy drain because you have to continually do research, you have to buy, you have to sell, you have to worry about when your business is reaching its intrinsic value. And that's sort of a mental treadmill that he's not willing to run anymore. He often talks about in the past he has struggled holding on to exceptional businesses that look fully valued or slightly overvalued, even if it does hurt him in the long run. He gives an example of a past mistake he's made with how he handled the shares of Ferrari that he received when it was spun out from Fiat Chrysler in 2015. He received about $23 million worth of Ferrari shares when it was spun out, and he held on to those for several years, but he ended up selling it for about $101 million when it was all said and done. It sounds like a pretty great return, but not only did he have to pay taxes on that transaction, but if he had just simply held on to the Ferrari shares until today, that $101 million would actually be worth over $250 million. So here we're seeing Pabrai commit a mistake of omission instead of commission. He really wishes he could have held on to those Ferrari shares. He's made this same mistake in the past with other companies including Mautai, Google, and even Amazon way early in his investing career. All of these examples have helped reshape his approach to searching for compounding machines over finding 50-cent dollars. John Miljevic, who was interviewing Pabrai, asked Pabrai about the opportunity cost of holding on to these great businesses. And Pabrai said he was perfectly happy with holding a museum of excellent businesses in his portfolio. He reiterated that there's a frictional cost whenever you sell stocks because the capital gains are taxed. Secondly, he uses the colorful phrase, "The mistress always looks better than the wife." What he means by this is that there are always other opportunities that might look better than what's in your portfolio, but you really know the businesses in your portfolio a lot better. So it turns out that the wife actually always looks better than the mistress. So he's happy to buy something that he knows might triple in 3 years, but he's not going to sell one of his great businesses today unless it's egregiously priced. That's the old Mohnish, and he's not going back to it. The next lesson we can take away from Pabrai is that the best investors weren't actually investors at all. They were business owners and entrepreneurs who never sold. For example, we can look at Walmart and the Walton family, or Jeff Bezos and Amazon. The Walton family is probably the only family that has held Walmart shares from inception to this day. And Jeff Bezos probably has 99% of his net worth tied up in Amazon. Did this work out for the Waltons and the Jeff Bezoses of the world? The answer seems pretty obvious. These are obviously great businesses with great moats, great management, and very long runways. Later on in the Q&A, John asks Mohnish about the old saying, "Concentrate to build wealth and diversify to keep wealth." He brings up Nick Sleep's position in Amazon. He asks John, "Why should your framework be any different from Jeff Bezos' framework? If you truly understand the eggs in your basket, there is no reason to sell it." All of this has prompted Pabrai to think of himself not as an investor in a business, but as a passive owner. For example, he recently found 2 real estate companies, one in Turkey called Reysas and one in Japan called Shinouken. The Turkish company is family owned, and Pabrai has been able to take about a 30% stake in the company. He's investing alongside a family that will work hard for him and with a management that has actual skin in the game. By the way, he's funding a lot of businesses in South Korea, China, India, Turkey, and Japan. So if you all have any idea how to invest into Turkey as a US investor, please let me know in the comments below, because I'd really like to seriously look there. Finally, let's talk about how Pabrai's view of valuation has changed. Pabrai mentions that in the 80s, Walmart, by most metrics, looked very expensive, and Kmart looked undervalued on most metrics. But where are these companies now? So the key takeaway here is, don't fixate on the valuation of a business unless it is egregiously overpriced. Ask yourself one simple question. Is the business getting better, or is the business getting worse? If the business is in secular decline or is getting worse, then you should probably sell it. It's hard to turn around a sinking ship. But for instance, if Amazon today is fully priced or even overpriced, is it a good idea to sell it? Ask yourself, is Amazon's moat getting wider? Is their market share expanding? Are they spawning new ventures that have a pretty decent chance of success? Amazon has an amazingly diversified business. Obviously, we know that Amazon is a giant e-commerce behemoth, but they also have their Amazon Web Services business, which could be a standalone business in itself. So we wonder, is Amazon today in the same position Walmart was in the 80s when it looked overpriced? It's quite possible that Amazon has a really long runway and a lot of room for growth left. Depending on where you are in your investing journey, these lessons may or may not make a lot of sense to you. I'm not saying that these lessons won't work for you, but I am saying that Pabrai is in a very different place than probably most of the viewers of this video. Pabrai is already extremely wealthy, and he manages over $500 million. For instance, it's a lot easier to find these 50-cent dollar bills if you don't have that much money at work, and they will also make a much larger impact on your small portfolio. But it seems that as portfolio sizes grow, we saw Warren Buffett and now Mohnish Pabrai transitioning to really seeking out these compounding machines. So it seems like compounding machines are a great way to grow your wealth even if you have a large sum. As the amount of money that you have grows, it's harder and harder to find more opportunities. Either way, I would really encourage everyone to think about what Mohnish Pabrai has learned in 2020, whether or not you're looking for 50-cent dollars or compounding machines. I'm impressed that you've made it this far through the video. Thank you, by the way. Be sure to check out my curated investing playlist over here. I cover other topics in investing, from lessons from the intelligent investor to the current GameStop short squeeze situation. Please like the video and subscribe to the channel if you found this useful. Also, I've linked Mohnish's full talk down below in the description. Please listen to that in its entirety. There are plenty of gems that I didn't cover in this video that you might find useful. I really appreciate you watching this all the way to the end. Thank you very much, and I will see you next time.